Hi, I'm Damion from Luxury Property Partners, and today I want to talk to you about the shifting Oxfordshire property market. So the property market is on the verge of a tipping point. The rate of house price growth has started to ease, with a reduction in the number of properties that will sell in the next 12 to 18 months. Yet rising interest rates and the cost of living issues won't knock everybody out of the property market, and there shouldn't be a housing bubble for two vital reasons. So the property market is on the cusp of this tipping point, and it's a tipping point that will influence house prices, the number of properties available to buy, demand for those properties, and the lives of every homeowner and the property owning buy-to-let landlords here in Oxfordshire. This shift in the property market is a big deal, so I want to explain. So what are the two vital reasons for this shift in the property market? First, the easygoing property market goldmine of the past couple of years has to end. The bonanza of this market for house sellers, which is primarily fueled by cheap money, is receding, and the scales are starting to tip somewhat more in the favor toward buyers, which is not a bad thing, and I'll explain why later. Secondly, and more significantly, this shift in the property market is not a collapse, and I'll enlighten you to why I think this. So one of the key influencing factors of the property market is what people pay on their mortgages. The higher the mortgage interest rate, the higher the mortgage payments. Mortgage rates are usually 1 to 2% higher than the Bank of England base rate. Therefore, mortgage rates are increasing on the back of higher Bank of England interest rates. So whilst we have seen rates rise 4 times in the last year, the Bank of England base rate stands at only 1%. Compare that with the Bank of England base rates in the 80s, when the average was 12.5%. In the 90s, it was around 9%. And in the 2000s, when the average base rate was 4.7%. These high base rates, together with high unemployment, contributed to the woes of the UK property market crashes of the early 90s and 2008. From the gloomiest economist, the worst case scenario doesn't see the Bank of England base rates rising past 3%. This means the prospect of a housing crash is minimal because of the comparatively low unemployment and base rates still at all-time lows. So what are the signs of the shift in the property market? The statistics show a slight shift in the scales between it being a 100% sellers market for the last 2 years and more to a 80% sellers and 20% buyers market, and here are my reasons why. So number one, the number of houses for sale has grown by 17% in the last 6 months, and nationally the number of properties available to buy is increased by 17%, rising from 400,000 to 450,000 by the end of May. The rise in the number of properties on the market is a crucial component of the housing market puzzle, and I'll explain why. So before COVID, house buyers having more choice of properties to buy in the summer months would have been thought unremarkable, yet the stark shortage of properties to buy in the last couple of years has caused national house prices to drop by almost 20%. Any growth or reduction in the number of properties for sale is significant, hence a key bellwether. This means that the buyers will have more choice of properties to buy this summer. The number of properties sold in the UK has dropped by 11.5% year to date 2022 versus 2021. And when I say sold in this context, I mean the month the house price is agreed and the sold ball goes up, not completion and when the keys are handed over. And looking at the national number of properties sold on a month-to-month basis, things have started to shift since March. In February 2021, 110,000 houses sold in the UK compared to 117,000 for the same month in 2022. It's basically identical, yet March 2022 saw 15% fewer houses sell in the UK than in March 2021. April saw 20% fewer houses sold than last year, so it's not all doom and gloom, not at all. The spring months, March and April of 2021, saw this crazy rush for houses to be sold to beat the stamp duty holiday ending in June, so of course, March and April's figures, they're going to be lower. The panic buying of March and April 2021 returned to normal levels in May 2021, meaning the number of houses sold in May of this year was only 4% lower than last year. Number 3, the number of house price changes has increased by 70% since January. In January of this year, the number of house price changes was 27,000 and has been increasing steadily every single month to up to 45,000 in May, and that's an increase of 69%. This means that house sellers have to be more realistic with their house pricing and if they want to get their houses sold. So if you take all of these things together, you can see that there are signs that the Oxfordshire property market has started shifting more into a buyer's territory, yet it's a long way from the traditional idea of a buyer's market. These points can be backed up with the house price data for Oxford. Gone are the heady days of August of 2020 when house prices increased by 6.5% in a month. Last month, 1.7%. The month before, 1.8%. So it's not all doom and gloom when you consider that Oxfordshire house prices are still 8.7% higher than last year. We've been in fifth gear for the last 2 years with extra rockets attached, and we are certainly not going into reverse gear, more of a drop down the gears to fourth. And I know many aspiring Oxfordshire homeowners are waiting for house prices to fall. However, I don't foresee any large Oxfordshire price drops in the next few years. In essence, whilst I do believe the rate of house price growth will slow down, that does not mean that it's going to go into reverse. Some would ask what increasing interest rates and inflation will do to the property market, and as I've already discussed several recent articles of mine, interest rates, if they don't go above 3.5% to 4%, this won't be a game-changing issue for the property market. Most homeowners are reasonably long-term fixed mortgages, which are typically 5+ years, and will be able to transfer them across to the new house purchase if they want to move. Of course, that will not help first-time buyers, and I agree there will be fewer first-time buyers, but these will be replaced by landlords re-entering the Oxfordshire property market, as I discussed a few weeks ago. So Oxfordshire house prices will also be further protected by the effect of inflation on house prices. Again, I discussed this recently, so check out that video. As the number of properties coming to market has increased, the choice of properties to buy has expanded. This will encourage those potential cash home buyers who have also been waiting on the sidelines alongside the landlords to start viewing and making offers. They too have not wished to get into a bidding war, but patiently waited for the market to ease. And it's for those reasons in my article today and my other recent articles mentioned above that I do not see an Oxfordshire housing bubble on the horizon. If you'd like those articles or any others, if you'd like to reach out, I'm always happy to help. This is Damion from Luxury Property Partners.